Hyperinflation is not merely rising prices. It is the collapse of money's meaning. It is the moment when currency stops functioning as a measure of value, a store of wealth, or a promise of tomorrow, and becomes instead an object to be discarded as quickly as possible. Societies do not drift gently into hyperinflation. They are pushed by war debt, political breakdown, and the desperate belief that printing money can substitute for trust. Throughout history, hyperinflation has followed a consistent pattern. First comes a shock war, revolution, sanctions, or state collapse. Productive capacity shrinks. Revenues fall. Obligations remain. Governments face a choice between default and debasement. Default is visible and humiliating. Debasement feels technical, reversible, and at first painless. And so the presses begin to run. In ancient Rome, emperors discovered this temptation early. Coins, once heavy with silver, were shaved, diluted, and reissued. The face of the emperor remained. The metal did not. Prices rose. Confidence eroded. Soldiers demanded more pay. The cycle fed itself. Rome did not experience hyperinflation as we define it today, but it experienced monetary decay, the ancestor of every modern episode. When money lies, society fractures. The modern age intensified this danger because paper money detached currency from physical constraint. Once gold backing disappeared, money became an instrument of policy rather than scarcity. This flexibility powered growth, but also enabled abuse. The most infamous case remains Weimar Germany. After World War I, Germany faced impossible arithmetic, reparations denominated in foreign currency, a devastated industrial base, political instability. The government chose monetization over confrontation. Marks were printed to buy dollars. Prices rose. Wages followed, but always behind. By 1923, the mark collapsed. Workers were paid twice a day so they could spend before value vanished. Savings accumulated over lifetimes were wiped out in weeks. Money became theater. What made Weimar hyperinflation so destructive was not only economic ruin, but moral disintegration. Contracts lost meaning. Thrift became foolish. Speculation became survival. Trust between citizens eroded. Extremism flourished in the vacuum. Hyperinflation did not cause political collapse alone, but it prepared the ground. This pattern repeats across continents and decades. Hungary, after World War II, experienced the worst hyperinflation ever recorded. Prices doubled every 15 hours. Zimbabwe in the 2000s printed trillion-dollar notes to finance deficits amid agricultural collapse and sanctions. Venezuela followed a similar path, monetizing fiscal failure until currency disintegrated. In each case, leaders blamed speculation, hoarding, or foreign enemies. In each case, the cause was the same: spending unmoored from productive reality. Hyperinflation is therefore never a monetary accident. It is a fiscal event expressed through money. Central banks do not lose control spontaneously. They are compelled explicitly or implicitly to finance states that cannot tax, borrow, or reform. Printing becomes the path of least resistance. The human consequences are brutal. Middle classes vanish. Cash salaries become meaningless. Barter returns. Foreign currency circulates underground. Inequality explodes, not because the rich thrive, but because those with access to real assets or hard currency survive while others do not. Hyperinflation is regressive violence executed through arithmetic. Yet hyperinflation always contains denial at its core. Early stages feel manageable. Inflation stimulates spending. Debt burdens shrink in real terms. Governments convince themselves they can stop in time. They rarely do. Expectations adapt faster than policy. Once people lose faith in money, velocity explodes. Prices rise not because costs increase, but because no one wants to hold currency at all. At that point, control is already lost. History also shows that hyperinflation ends suddenly but painfully, either through stabilization anchored by credibility, often involving a new currency fiscal reform and external support, or through collapse and replacement. Trust must be rebuilt from zero. This is why hyperinflation scars societies for generations. Those who lived through it never forget what money can become. The critical insight is this: hyperinflation is not caused by too much money alone. It is caused by too little trust. Printing accelerates collapse only after legitimacy is already eroded. Strong states with credible taxation can print without hyperinflation. Weak states cannot. This distinction matters deeply in modern debates. Inflation fears often confuse monetary expansion with monetary breakdown. Hyperinflation is rare precisely because it requires political failure, not merely policy error. But when it arrives with devastating force. Standing amid the ruins of a hyperinflationary economy, one sees not charts, but human behavior transformed. People rush to spend. They hoard goods instead of currency. Time horizons collapse. Tomorrow becomes meaningless. Money, once society's quiet coordinator, becomes its loudest antagonist. The history of hyperinflation is therefore not primarily economic, it is institutional. It reveals what happens when states lose the capacity to extract resources legitimately and resort instead to extracting value through the printing press. It is the final stage of fiscal despair. And as modern economies carry unprecedented debt, polarized politics, and rising pressure on central banks, the ghost of hyperinflation remains a warning. Not that it is imminent everywhere, but that money ultimately rests on belief, and belief once broken cannot be repaired by policy statements or technical fixes. Alone, a warning that history has delivered repeatedly in moments when societies convinced themselves that monetary shortcuts could replace structural reform. A warning written not in textbooks, but in ruined savings. Empty shops and currencies weighed rather than counted, a warning, whose relevance grows whenever trust in institutions weakens, and the temptation to solve real problems with printed solutions returns a warning that leads inevitably to the question of how hyperinflation finally ends, who pays the cost of stabilization, and whether societies emerge stronger or permanently scarred, questions whose answers lie not in theory, but in the hard-earned lessons of the past, lessons that reveal that when money dies, it is never alone, but takes with it assumptions about stability, fairness, and order that must be rebuilt from the ground up. A rebuilding that only begins when the printing stops and reality is faced, a moment that marks the transition from denial to reckoning. A reckoning that arrives with a severity that leaves no room for illusion, because hyperinflation does not negotiate. It ends only when society accepts costs it has long postponed. The transition from monetary collapse to stability is never smooth, never painless, and never purely technical. It is political, social, and deeply moral. History shows that hyperinflation ends in one of two ways. Either the state reasserts credibility through decisive reform, or the currency is abandoned altogether. There is no middle path. Gradualism fails because trust, once destroyed, does not return incrementally. It returns only when people believe the rules have changed completely. In Weimar, Germany, stabilization came with the Rentenmark, backed not by gold, but by land and industrial assets, and more importantly, by a political commitment to stop monetizing deficits. Fiscal reform followed. Taxes were enforced. Spending was cut. Pain was immediate. Unemployment rose. Social tensions deepened. But money regained meaning. The lesson was brutal and clear: Currency stability is restored, not by printing less, but by governing more. Hungary's post-war hyperinflation ended even more abruptly. The old pengo was erased. A new forint was introduced. Prices were reset. Debts were redefined. The slate was wiped clean at the cost of wiping out savings entirely. Hyperinflation does not end by preserving wealth. It ends by redistributing losses so widely that the system can restart. Zimbabwe and Venezuela demonstrate the alternative path: prolonged denial. Reforms delayed. Blame externalized. Controls imposed. Each attempt to suppress symptoms without addressing cause extended suffering. When stabilization finally began, it came not from policy finesse, but from exhaustion, through dollarization collapse of formal markets and the informal rebuilding of trust from the bottom up. What unites these endings is the role of credibility. Central banks regain authority only when they are no longer instruments of fiscal desperation. Governments regain trust only when they accept limits. Hyperinflation ends when society collectively agrees that pretending is more costly than confronting reality. The social scars remain long after prices stabilize. Generations who lived through hyperinflation carry a permanent suspicion of debt deficits and paper promises. This memory shapes national policy for decades. Germany's post-war obsession with price stability was not ideological. It was traumatic. Latin American inflation-targeting regimes were born from lived catastrophe, not academic theory. This is why hyperinflation is rare but formative. It doesn't recur easily in the same society because memory disciplines behavior. The danger lies not with those who remember collapse, but with those who study it abstractly and believe themselves immune. The final lesson of hyperinflation is therefore not about money supply. It is about legitimacy. Money works when people believe the state has both the capacity and the will to govern honestly within constraints. When that belief erodes, no technical fix can substitute for trust. Hyperinflation is the extreme edge of financial history, but its warning applies far earlier. Every system that blurs fiscal responsibility, pressures monetary institutions, and substitutes narrative for arithmetic moves closer to the same cliff. The difference is not direction, but speed. If this journey through hyperinflation changed how you see inflation, fears central bank power, or the fragility of money, share what struck you most. And if you want to continue exploring how financial collapse reshapes societies from the inside out, follow the channel and stay with this story. Because when money loses its value, it reveals what truly holds a society together. And history shows that rebuilding that foundation is always harder than destroying it.